Okay, let's continue. Let's proceed to problem 5-12. What amount should be reported as cash received from the bond issuance? Basically, the same question in problem 5-11. Okay. Here, the issuance date is on April 1, 2022. And if you look at the rest of the problems, you would learn that the interest payment dates are on January 1 and July 1. So meaning this is another example of a problem where the issuance date does not fall on any of the interest payment dates. And that is something to take note of because there will be an impact on the amount of money that we will get from the issuance, the entity will get from the issuance of the bond. Okay. Uh, let's see. We need first to get the price of the bond, and as stated here, it is 99. It is quoted at 99, meaning the price is 99% of its face value. And please do not expect always, Klasa, that the face value would be 5 million. Always check the problem. In this case, the total face value will be 4 million, since the bonds here are 4,000 pieces with a face amount of 1,000 peso each. So the total face value or face amount is 4 million, and the price is at 99%. So you simply multiply 4 million with 99%, you would get 3,960,000. Please review my computation, because 4 million times 99% or simply minus 1%, that should be 3,960,000. That is the price of the bond. But again, as already explained earlier, that's not the only thing that will be taken into account. Okay, you will have to check for bond issuance cost, because again, this should be offset against the money that you would get from the sale or issuance of the bond. The price will serve as an inflow. The bond issuance cost would be an outflow on the part of the issuing entity. And supposedly, those are the only two things that you will have to take into account. But if ever the issuance date does not fall on any of the interest payment dates, you will have to take into account the accrued interest, the interest that has accrued from the last interest payment date to the issuance date. So when do you think, if the interest payment dates are January 1 and July 1, when do you think was the last payment date? Was it January or July? Okay, this is where students get it wrong, because they would get the period incorrect. Okay, to get the correct amount of accrued interest, you should be able to determine the correct period of accrual. Okay, so if the issuance date is on April 1, the last issuance date would be January 1 and not July 1. Okay, so as of April 1, the last interest payment date is January 1. And you will now have to determine or count the number of periods the number of months that has passed from January 1 to April 1. January, February, and March, you will have a total of 3 months. Okay, and this is the problem with the illustrative problems that we get from the textbook. It's always in the middle class. Students get confused because the correct amount of accrual period here is 3 months. Okay, but whether or not you know where to reckon the 3 months class, where to start counting the 3 months, you would still arrive at the same number. What do I mean? What if you incorrectly thought that the period that you will have to determine is from the issuance date to the next interest payment date? When was the issuance date? April 1. When is the next interest payment date? July. So if that includes July, because it's the first day of July. So whether or not you know what is the correct accrual period, you will still arrive at the same figure class. For those that will only answer very few problems class. Even if we go to problem 5-11, okay, We've determined also that the number of months wherein there is an accrued interest is also 3 months. But again, where should we be counting? Where should we be counting the 3 months? It should be from the last. We should begin from the last interest payment date, which was July 1. Again, I went back to problem 5-11 class. Okay, the last interest payment date here is July 1. Okay, and then from July we counted 3 months up to October 1. Okay, we concluded that there were 3 months in between July 1 and October 1. But what if your starting point was wrong, class? You started at October 1 and you counted towards the next interest payment date, which is January 1. So from October 1 to January 1, there's also 3 months. Okay? Because the illustration in the textbook is always in the middle class, some students would get wrong understanding as to the computation of your accrued interest class. It should be from the last interest payment date to the date of issuance. Better problems would have been 4 months in between or 2 months in between. Okay, but these are the problems given to us. Just be careful. It should be from the last interest payment date to the issuance date. That is the period that will result in accrued interest. And as explained earlier, class, the buyer will have to pay the accrued interest so as to simplify the eventual payment of interest in the next interest payment date. Since the amount of interest that will be paid in the next interest payment date will be fixed, so as not to complicate the computation, the buyer will have to pay the extra interest that it will be receiving during the next interest payment date. Okay, so let's now go back to problem 5-12 and answer the problem. How much was the price of the bond? It's 3,960,000. And supposedly, we will just have to deduct the bond issuance cost of 140. But since this is a problem where the issuance date does not fall on any of the interest payment dates, we will have to take into account the accrued interest that has accrued from the last interest payment date to the date of issuance, which is to be paid by the buyer, which is an additional inflow on the part of the issuing entity. Okay, we already have the 3,960,000. We already have the 140. Then we will also have, we'll just have to compute for the accrued interest. Again, the accrued interest here is from January to April, and that's for 3 months. Now, how much is the accrued interest? Okay, in computing for the accrued interest class, it should be based on the stated or the nominal rate class. It should be based on the rate stated on the bond. And the stated rate in this problem is 8%. Okay, so can someone help me here? How much is 4 million times 8% times 3/12?
80,000.
80,000. Okay. So you have your 3,960,000. Then you add the 80,000. You should get 4,040,000, and then deduct your 140,000. We would get 3,900,000, and that will already be your answer in this problem. Okay. Now, again, class, if you browse through chapter 5, class, again, there are a lot of complicated scenarios there. Okay, but let's just focus on the simple questions first. Okay, let's make sure we can take care of the simple questions. So in any time that you are asked for cash proceeds, again, it's basically just the price of the bond minus any bond issuance cost. But you have to be careful if the issuance date does not fall on any of the interest payment dates. You will have to take into account the accrued interest, and be careful in the computation of your accrued interest. Okay. Now let's proceed to problem 5-13. On July 1, 2022, car company issued at 104. 104 would be our quotation price or our rate. 5,000, 10% bonds payable with face amount of 1,000 per bond. So basically, the total face value is 5 million. The bonds were issued through an underwriter to whom the entity paid bond issuance cost of 125,000. On July 1, 2022, what is the carrying amount of the bonds? What is the carrying amount of the bonds payable? Okay, so let's get the price, the selling price first. How much are we getting from issuing the bond class? It's 104. 5 million times 104 uh, will give us 5,200,000. Okay, and then we have bond issuance cost of 125. So you deduct the 125 from 5,200,000, you would get your carrying amount of 5,075,000. Okay, and in this case, class, the carrying amount will be the same as the amount of cash received. So if you are asked how much cash is received, your answer would have been 5,075 also. So in cases, class, the wherein uh, the issuance date falls the on any of the interest payment dates, class, in that case, the carrying amount will be the same as the initial carrying amount. The initial carrying amount will be the same as the amount of cash received. Okay. We are asked for carrying amount in this problem, class, but since the carrying amount asked is the same date as the date of issuance, so basically you are asked for the initial carrying amount. The 5,075,000 here will also serve as the initial carrying amount. Okay. There's nothing tricky for problem 5-30. Let's have problem 5-14. During the current year, Kane Company incurred the following costs in connection with the issuance of bonds. So basically, this is just a test on whether or not you can identify what can qualify as a bond issuance cost. So any bond issuance cost that is any cost incurred in relation to the issuance of bonds, would be considered as a bond issuance cost. Okay, and in this problem, class, all these 5 items will form part of our bond issuance cost. The promotion cost to inform capital providers that we are issuing bonds, the printing and engraving of the bonds, legal fees related to the issuance of the bond, fees paid to independent accountants for the registration of the bond information, commissions paid to underwriter will all qualify as a bond issuance cost. So if you add all of them together, class, you should get 2,150,000. Let us just end here, class, and I will just